Volatility is back on Wall Street, all smiles on Dalal Street, and Oracle climbs the tech ladder. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode, episode 141 of the Stock Doctor podcast. First things first, just like volatility is back on Wall Street, I'm back as well. And first things first, before we get on to the show, a very, very belated but happy Diwali to all my Indian listeners. Hope all of you had a lovely time with your families and enjoyed the festivities. I hope you're enjoying the holiday today. I know the festive season's coming to an end, so I hope you're getting as much quality time with your families and your loved ones as you can. So really, from the bottom of my heart, a very happy Diwali to you. Secondly, I really, really apologize for the radio silence. I know it's been a week, it's been nearly a month since the last episode, the fourth anniversary special was out. I apologize for the radio silence. The show is very much alive and kicking. It's not like we did the fourth anniversary and that's the end of that. It's the end of the season or end of the show or curtains down or any of that sort. Nothing negative. It's just the fact that I had a lot of personal commitments to take care of. So a lot of unforeseen circumstances to deal with, all of which forced me to put the brakes on the show. Couldn't do it all. But as things stand, normalcy is back. We are, normalcy is back. Normalcy should resume from now on. I know the episode is getting released on Wednesday for this week, but from next week, hopefully, as things stand, we will be back on our Tuesday 12 p.m. slot. So it should be. So I apologize for the radio silence, but all I want to say right now is thank you for the patience. And like I said, on the occasion of the fourth anniversary special, thank you for all the love and support that you've given me over the years, and I'm sure that you will continue to give me. By the way, I'm glad that you guys have enjoyed the fourth anniversary special. Got some lot of positive feedback, and also at the same time, there was a lot of views, there was a lot of comments, a lot of feedback. So thank you all, and please continue to show all the love you can for the show. Really, really appreciate it. Right. Diwali greetings over, apologies over, back to the markets now. So much has happened since we last left off. Like I said, been nearly a month. The one constant that has remained all these nearly 4 weeks is that volatility continues to be the name of the game. Markets may be at an all-time highs now, but unless you've been living under a rock, you would know that the path to these all-time highs was anything but straightforward. You have the US government shutdown that yesterday completed 3 weeks. And shows no signs of ending. In fact, we are on day 22 today as things stand, and it shows no signs of ending. You have the US-China trade tensions that are taking a new twist. And most importantly, we are officially, ladies and gentlemen, we are officially into the Q3 earnings season. Now, the week gone by, as I will discuss in a moment from now, was affected by all these elements. And yet once the dust had settled, markets finished the week solidly in the green. And that's the other constant. You can, you can go through all the negativities, you can go through all the ups and downs, you can go through all of that. For most of the weeks since we last stopped recording, you could see that, once the dust had settled, you look at your portfolio and you're like, and it's still in the green. But that green is anything but straightforward. But this week was no different. Markets finished solidly in the week in the green, with the Dow adding 1.6%, S&P 500 gaining 1.7%, and the tech-heavy NASDAQ finishing the week up 2.1%. So, not going to waste much time. I'm going to welcome you to the first segment, Doctor's Weekly Snapshot, and take you through some of the key developments of the week. Now, we start off with one of the key drivers of the markets, and that's the official kickoff of the Q3 earnings season. I am going to keep moving my tablet a bit while I settle in. Yeah, there you go. So we start off with one of the key drivers of the markets, and that's the official kickoff of the Q3 season, and headlined by none other than the big banks. We've gone through the motions. Normally, the big banks officially, there's no official, but there's big banks are the ones who normally kick things off in every earnings season. And the key message that's coming out from the big banks in the US is that whatever negativity surrounding the US economy, whatever volatility you guys are talking about, you and I can talk about all the volatility we want, but all that volatility, all that negativity surrounding the US economy is yet to reach the US consumer. That's the big message from the big banks. Top banking executives from the likes of Bank of America, Morgan Stanley, JP Morgan, all mentioned that while the economic backdrop is riddled with uncertainty, spending by US consumers and businesses continue to remain resilient. And this is despite the inflation and the Trump administration's economic tariff policies. At the same time, a surge in deal-making, corporate lending, and trading activity generated strong growth for the trading and investment banking divisions of the likes of Goldman Sachs, JP Morgan, Morgan Stanley, you name it, all the big banks that deal with investment banking. Combined, the total earnings from the six largest US banks for Q3 came in at nearly $41 billion. This is not sales, this is actual profits, the bottom line. $41 billion, and that's up 19% year over year, which ensured that the Q3 earnings season has been off to a strong start. And when you have strong earnings, it can only be positive for the markets, which turned out to be the case. Now, you know why, despite all the volatility and the negativity, at the end of the day, markets did end the week in the green, despite the the uncertainty. Big banks are continuing to see a resilient US consumer. Now, I'm not saying it was all positive. Definitely not. That's never the case anyway. Despite delivering strong earnings, which bank executives were quick to cite that the slowing jobs market, tariff uncertainties, and possible asset bubbles as key headwinds going forward. At the same time, there are also certain worrying signs that are emerging, especially in the US regional banking space. More specifically, there have been a new wave of credit fraud allegations from the regional banking space, with the likes of Zion Bank Corp, which had a strong quarter nonetheless, and Western Alliance Bank Corp, which also had a strong quarter nonetheless, disclosing substantial loan losses and lawsuits involving allegedly fraudulent borrowers. The latest disclosures follow the bankruptcies of auto supplier First Brands, where some fraud is allegedly there, and subprime lender Tricolor, which had already raised concerns about credit qualities and underwriting standards across mid-tier lenders. While most bank executives reassured investors by characterizing these incidents as isolated and also citing persistent inflation as one of the key factors pushing more companies into distress, investors were certainly alarmed by the recent developments, as evidenced by the 6.3% decline seen in the KBW NASDAQ Regional Bank Index following the disclosures by the likes of Western Alliance Bank Corp and Zions Bank Corp. It also didn't help that JP Morgan CEO Jamie Dimon, who is well known for his colorful adjectives. You would have seen me quote many of his adjectives. Normally it's weather-related, hurricanes and tornadoes and so on. Now, he's got a new narrative, new phrase about the credit quality concerns. And the quote is, when you see one cockroach, there are probably more. This led to financial media talking so much about metaphorical cockroaches that it caused investor confidence to become more fragile. I don't even know where we're going at this stage, guys. But so many metaphors, apparently metaphors are what drives markets. Confidence seems to be back up from again, although the confidence does seem to remain on a very sticky wicket. If you are a cricket lover, you would get the reference. Now, well, so from tornadoes, we are now into cockroaches, and the metaphorical cockroaches seem to be creating a lot of trouble, a lot of concern for investors. Like I said, now the regional bank losses and fraud concerns occurred at the same time as trade tensions with China took a whole new twist, and worries about AI valuations certainly returned. All of which meant that the volatility was certainly back. Volatility is the name of the game. Volatility is the name of the game. Chant that 1,000 times because that's exactly the case, as evidenced by a sudden jump in the VIX, which is the volatility index, after a 33-day period in which the S&P 500 had not moved more than 1% in either direction. So that 33-day streak has been broken by metaphorical cockroaches. That's all I'm going to say. You can't make up this. You can't make up this script. It's not about. This is not me writing a script for the show. This actually happened. 33-day record streak. A 33-day insane streak for the S&P 500, not moving 1% in either direction. It's been broken by metaphorical cockroaches, which is a worsening credit. A credit, not a credit crisis, but certainly a credit headache, you could say. Now, after President Trump announced the fresh 100% tariffs from November 1st, when China further tightened its noose around the export controls on rare earth materials, China showed absolutely no signs of backing down, as evidenced by the sanctions placed on the US entities of South Korea's Hanwha Ocean. As things stand, investors still don't know how all of this is going to end. We never do. And all eyes will be on the mega showdown between President Trump and President Xi, scheduled to take place as things stand. These things are very, very volatile. As things stand in South Korea next week. Now, while I do expect the narrative to turn positive should this meeting take place, I just don't see any end to the uncertainty anytime soon when US and China are concerned. And it seems that markets are also taking this in stride, given President Trump's track record of quickly backtracking when stock markets get rattled. A pattern, by the way, according to a recent Wall Street Journal report, that the Chinese appear to be taking advantage of. They clearly know President Trump loves the stock markets. He's quoted stock market rallies as part of his legacy, as part of his presidential track record, and seems that the Chinese are onto it. And therefore, for every threat that President Trump places on China, they seem to be not bothered as much. So not sure how far this, dance is going to last. But for now, that seems to be the case. The Chinese officials seem to be taking advantage of the fact that, President Trump loves the stock markets. He won't let them fall down. So he won't let them rattle, as they say. So not quite sure to what end or how long it's going to last. But for now, that seems to be the game. Finally, what do you do if you're the Fed, guys? Talked about China, talked about Q3 earnings. What do you do with the Fed? I mean, I don't know. I'm thinking. What do you do if you're the Fed? With the government shutdown entering day 22 today, as things stand, and showing no signs of slowing down, the Fed remains in the dark with respect to how the economy is doing. After all, how do you become data dependent when there's no data to be dependent on, right? So if you're literally in Chair Powell's shoes, you are in for a lot of headache because you can't be data dependent because there's no data to be dependent upon. There was no jobs report for September, just to make things really clear. And the CPI data, which was expected to be released last week, something I thought I would be discussing this week, is getting released at the end of this week. Now, how accurate the data would be is anyone's guess, given the fact that we're already two weeks due. The actual data was supposed to release. Now, Fed Chair Jerome Powell, speaking at an economics conference, acknowledged that the missing data would make things more challenging. No surprises there, and said that the central bank is relying increasingly on private sector indicators and anecdotal feedback from businesses. Now, while any data is good, the problem with these alternative sources is that they lack the consistency and the nationwide coverage that the government statistics have. Although I have to say right now, after the massive revisions that we've seen in the US jobs data that even led to the firing of the BLS commissioner, I'm not even sure whether government statistics is the gold standard that they once were. Not sure, but that debate is for another day. If we were to debate this, throughout, then we will be in here for more than 40 minutes that the show normally goes on. As things stand, the Fed is, all you got to know is as things stand, the Fed is expected to cut another 25 basis point at its next meeting scheduled next week, something that we will cover not in next episode, but the episode certainly after that, which would be the right move, in my opinion, given that whatever employment data investors can get their hands on, and I have got my hands on, given the fact I am a US investor, all of them point to the fact that the US labor market continues to deteriorate. So looks like a 25 basis point cut is definitely, in the books. Would be surprised if there is no rate cut at the next meeting. Fed Chair Powell more or less indicated in his latest remarks at the conference when he highlighted significant downside risks, his words not mine, in the job market, with both the supply and demand for labor declining sharply. He also did not push back against expectations of another rate cut reduction at the October meeting, although he reinforced something that he's always been reinforcing time and time again. It's that the Fed's dual commitment to stabilizing both inflation and employment, emphasizing the growing risks to labor market, even as price pressures remain elevated. So he did say there is no risk-free path for the Fed. I mean, which kind of, which I can't really argue because it is true. If you really think about it, tariffs have driven up inflation. Not to the extent that everybody feared, but they're still there. And you have a weakening labor market. So it's not exactly, it's not exactly I can choose one way or the other. But nonetheless, 25 basis point cut is on its way. If you think why I am moving back and forth, I really need to hire a producer, guys. That's why moving back and forth. I'm trying to align the camera in a way that it's much, that makes it very clear viewing, because there seems to be some light. At the same time, there is a script, obviously. So I'm looking at this. When I say script, there are notes. So I'm going to constantly look, and I don't want to keep looking at the notes and then looking back, looking back. Hopefully next week, the next episode, this will get resolved. Else I might get a, or if any of you are interested in producing the show, do reach out. Anyway, coming back to the show, bottom line, if you look at all the developments that I discussed with you guys today, then one can clearly see why volatility is well and truly back. And I'm not talking about the constant movements that I'm making. No, I'm not talking about that. I'm talking about actual market volatility. Nothing is really set in stone, and the entire macro picture can change in the blink of an eye. The one thing that is going for the markets for now is that earnings season has been off to a strong start. And it is imperative that earnings continue to deliver. If they bring in uncertainty, if earnings bring in volatility as well, and ladies and gentlemen, the 33-day streak may not be, that where the S&P 500 was very calm, everything was green, everything was hunky-dory for investors, that might not be on the table anymore. On that cautious note, let's head to the next segment. Doctor goes home, where India had a very truncated week because of Diwali festivities, and rightfully so. Everybody should celebrate. Diwali is one of my favorite holidays. So it wasn't. So I'm glad it's a truncated week in the Indian markets. As an Indian investor, it's not that I have to wake up and then check the markets time and time again, and I'm like, oh, I get 2 days off. No, that's not why it is. It's the fact that it's happy days. It's festivity season. So, truncated week in the Indian markets on account of Diwali festivities. We had the Muhurat trading, however, yesterday, as we welcomed Samava 2082, welcomed in the new year. And, I don't really pay much attention to the Muhurat trading because of the simple fact that everybody will, markets tend to normally go up because as it's sort of a good auspicious gesture to trade on that particular day. So I don't really look at the market overall picture based on that 1 hour of trading session. But nonetheless, Muhurat session was yesterday. So not technically a holiday, but today we are on full market shutdown. Now, despite it, even though the week was truncated, that doesn't mean that investors don't have any developments to think about. Never. Markets always give you information. It's like they're going on a holiday, but they'll still give you homework. So it's the homework. But the only thing is this week, all the homework seems to be very positive. All smiles for Indian investors, to be honest, as the GST 2.0 reforms are really doing their bit to ensure that the Indian economy keeps powering through despite the tariff uncertainties and the related geopolitics. And no bigger evidence of this than the sales during the festive season, which ended on a record-breaking note. Sales across key consumer categories, cars, smartphones, white goods, and apparel soared up to 50% compared to last year. It marked the strongest growth in over a decade, primarily driven by GST 2.0 reforms, coupled with the income tax rate cuts that boosted disposable income. So everything that I have been talking to you guys all along, income tax cuts, GST 2.0, all of that was clearly visible, clearly evident in this festivity season. So the investors were betting the festivity season turns out to be good. That's exactly what it happened. That's exactly how it turned out to be the case. 50% complete record for GST's happy days for happy days for consumers, happy days for businesses, happy days for investors. Additionally, a stable repo rate, consumer finance support, and heavy manufacturer discounts amplified the demand recovery after several subdued quarters. Might not show up in this earnings season, but Q3 is going to be really, really interesting, guys. I'm just going to put this here because the sun's back after a couple of gloomy days in London, and seems to be direct reflection. Anyway, the festive season is shaping up to be a structural turning point in India's consumer cycle, a point that has been acknowledged by many other analysts as well. Furthermore, inflation picture in India is looking a lot better compared to the US. If Fed Chair Jerome Powell has said no risk-free path in US, in India there is a risk-free path, and that is the inflation way. And because inflation is certainly heading downward, heading in the right direction. India's retail inflation fell sharply to 1.54%. You cannot make this up. Can't make this up. 1.54% in September 2025, moving below RBI's lower target range of 2 to 6. Remember, they have a 2 to 6%. This has gone below 2%, and it's gone it's nearly breaching the 1.5 level, which is fantastic. It's not deflation, it's just cooling inflation, which is fantastic, which is great news. The decline marks the lowest level in nearly a decade, driven predominantly by a steep fall in food prices and continued moderation across most consumption categories. And according to a recent Union Bank of India report, India's retail inflation is expected to decline further in October 2025, continuing its steep downward trajectory due to a high base effect, delayed food price seasonality, and the full impact of the GST rate reforms. The report forecasts that CPI inflation will drop below, get this, again, I'm not making this is Union Bank of, this is clearly data dependent. According to Union Bank of India's report, CPI inflation will drop below 0.5% in October, potentially making one of India's lowest inflation prints in decades. Remember, this is one report. Obviously, I have not clubbed together multiple reports, from multiple economists. One report, and if it's 0.5%, then boy, are in for a good ride for Indian consumers. Fantastic for businesses as well, because it would drive up consumption. Food inflation is projected to remain in the negative zone throughout the winter months, according to the report, as the impact of the earlier floods is waned and vegetable and edible oils prices stay deflated. Reflecting the sustained moderation, FY26 CPI forecast by the UBI report was revised down to 2.6% from 3.1%, signaling an extended period of inflation below RBI's 2 to 6% range. Remember, I'm only talking about one economist report, so take it with a pinch of salt for sure. Look through the other reports as well. I'll be covering more reports in the subsequent episodes, and then we'll get a clearer picture. Economists expect only a mild uptick in Q4 of FY26, around 4% due to base effects, while the rest of the fiscal year will likely see sub-target inflation. All of this is one report. Now, the improving inflation dynamics along with the GST reform should lead the RBI's Monetary Policy Committee to a further rate cut before the end of the year. That's not just me saying it, and you know how I'm saying it? Because I read a report by Goldman Sachs. So according to a recent report from Goldman Sachs, it's all data dependent. Every information that I'm telling you guys is all data dependent. Obviously, you've got to do your own due diligence as well. Do share in with your new insights. Obviously, you can comment on the new insights when the video just does go up. Happy to hear fresh insights, fresh perspectives from you, and then we'll put it all together and make money together, because that's the point at the end of the day, right? We all make money together. Now, Goldman Sachs expects a 25 basis point rate cut before year end, positioning it as a continuation of the RBI's pro-growth monetary bias. The RBI governor's monetary policy statement has opened up the possibility of another 25 basis point rate cut, even as the central bank decided to maintain the status quo on key rates and retain a neutral stance at its last meeting. According to the policy statement, the current macro conditions and outlook have created space for further policy easing to support growth. And this statement is just being supported further by this report from Goldman Sachs. So all in all, it's all smiles for Indian investors. Despite FIIs continuing to offload shares, the markets, based on all these developments, have managed to remain resilient, as evidenced by the nearly 3% move in both indices in the last 1 month, upward that is. Having said that, the path forward isn't straightforward at all. When is it, right? Domestically, the labor market remains weak, as evidenced by the increase in the unemployment rate in September, when unemployment went up from 5.1% to 5.2%. And then there is the ongoing tariff uncertainties with the US as the India-US trade deal talks drag on. While India's exports have remained resilient overall, expanding 6.7% year over year in September and about 9% year over year in Q2 of FY26, reversing a 7% contraction in the same quarter a year earlier, there is a heavy reliance on sectors such as electronics. While not exactly worrying in the moment, in the long term, over-reliance on one sector is simply not sustainable, in my opinion. As such, India's export diversification strategy needs policy support through more FTAs, and it is imperative, whether we like it or not, whether the Indian government likes it or not, that India closes its trade deal with the United States as soon as possible. Finally, how India Inc. fares in Q2 as far as earnings are concerned is also something that investors need to watch out for. So I'm going to leave you with this. Enjoy the festivities, enjoy the positives, but don't forget to keep an eye on the challenges before they actually become a headache. Happy Diwali once again. And on that note, let's head now to the final segment, Dr. Dissects. Now this week, I will be dissecting a company that has been getting all the attention in the world, that's been definitely on the spotlight for the last 2-3 weeks. Not just because of its volatile nature of how the stock performs, but also in general. It's relatively stayed. It's been getting all the positive attention surrounding AI. And no, it's not Nvidia. Every time AI, it's Nvidia. No, certainly, the stock is certainly one that plays in the AI space. It's not Nvidia. The company going under the microscope, without further ado, this week, ladies and gentlemen, is Oracle, ticker ORCL. Now, Oracle released its Q1 earnings last month, and it was a decent quarter, in my opinion, despite missing on both the top and bottom lines. More specifically, Q1 revenues came in at $14.9 billion, up 12.2% year over year, missing analyst estimates, though, by 117 million. Excuse me, non-GAAP EPS came in at $1.47, marginally beating the company's low end of the guidance, but missing out on analyst estimates by 1 cent. So call it essentially flat. Call it essentially in line, not flat. Cloud infrastructure, however, continued its upward trajectory. Revenues jumping 54% year over year in constant currency. Non-GAAP operating margins came in at 42%, a decline of 100 basis points and a decline of 200 basis points on a sequential basis. CapEx surged once again, coming in at $27.4 billion, a significant jump from the Q4 figure of $21.2 billion. Finally, management maintained their quarterly dividend of 50 cents per share. Now, despite the Q1 miss, management reiterated their confidence in FY26 revenue growth, coming in at 16% year over year in constant currency. For Q2, management now expects revenues to grow between 12 and 14% in constant currency. Non-GAAP EPS is expected to grow between 10 and 12%, and they expect it to come in the range between $1.61 and $1.65. Furthermore, during its recently concluded Investor Day, the company also set long-term FY 2030 goals, which is what really drove the stock upwards in recent times. And the long-term goals included annual revenues of $225 billion, which would amount to a 31% 5-year CAGR. EPS is projected to reach $21, reflecting a 28% CAGR. And OCI revenue target increased to $166 billion, comprising 75% of the total sales. AI and GPU margins were also expected to be in the range of between 30 to 40%, which is massive in my opinion with all the spending that's needed. So I am going to put a question mark on this. However, it did surpass analyst estimates. Now, the last time I dissected Oracle, you guys know I love the company. I'm a shareholder in the company, although I have trimmed my position after the monster jump it's seen. So the last time I did dissect Oracle, I talked about how the company is starting to deliver, and it was hard to find any meaningful weakness in its AI journey. Oracle's Q1 performance not only reaffirmed this notion, but went a step further and demonstrated why the company deserves to be mentioned in the same breath as the likes of Meta, Amazon, and Microsoft and Nvidia when it comes to the AI revolution. The headline numbers may have been a dampener, and investors, in my opinion, certainly shouldn't ignore them. However, if one does a deep dive analysis on some of the company's metrics, which I'm doing for you guys, then one can conclude that the company's growth story may have actually gone up a notch, especially regarding its cloud infrastructure business. Since I started my coverage on Oracle, since I started investing in Oracle, since I started dissecting Oracle, however you want to put it, I've repeatedly highlighted how the company's remaining performance obligations, or RPOs, have maintained strong growth with each passing quarter. In Q1, however, the RPO didn't just maintain strong growth. Instead, they reached stratospheric levels. It just exploded. More specifically, Q1 RPOs came in at $455 billion, which amounts to a year-over-year growth of 359%. Write that down. Write that down, ladies and gentlemen. I know I only write down from Oracle valuation, but that's 359% jump. I am not making this up at all. Blowing past street estimates, which were actually around 180 billion. They expected 180 billion. You've nearly tripled it. 455. To put this astounding growth into perspective, the $455 billion in RPO represents an increase of $317 billion from Q4 when they stood at $138 billion. So it's absolutely monster numbers. Furthermore, the company's multi-cloud database revenues grew a whopping 1,500 129%. Again, I am not making this up. 1,529% in Q1. And with another 37 data centers expected to go live soon, the revenues from the hyperscalers such as AWS, Azure, and GCP, Google Cloud Platforms, are only set to grow even more. I'm actually losing breath. Such has been the astronomical number. Finally, the company also announced that ChatGPT parent OpenAI has inked a deal with Oracle to purchase $300 billion in computing power over roughly 5 years, which would contribute further to the company's explosive revenue growth. Now, there was a cause for concern at the end of Q4 when RPO growth dramatically slowed down from 63 to 41. Questions were once again raised whether all the CapEx spending the company was undertaking would yield such results or whether the AI revolution was slowing down. Q1 dispelled any such concern, and while the RPO growth may not reach such stratospheric levels in the coming quarters, the fact that OCI revenues are expected to reach $144 billion in the next 4 years from $18 billion in the current fiscal year does suggest that the massive backlog is actually getting converted into top-line growth at a rapid pace. And if the company has to keep spending to make it happen, why not? Go for it, is all I would say. And during the Investor Day, Oracle positioned itself as a full-stack AI and cloud company, extending from infrastructure to enterprise applications. Good news, just keep rolling. The company launched the AI data platform to integrate private enterprise data with generative AI and introduce AI agents in Fusion apps, signaling deeper AI stack embedding. Partnerships with OpenAI, Meta, and TikTok were highlighted, emphasizing Oracle's accelerated presence in large-scale cloud workloads. If Q4 was when Oracle finally started to show investors that it was delivering after spending massively, then Q1 and the recently concluded Investor Day not only cemented that notion, but also put Oracle in the major leagues of the AI revolution. That's why I started the show by saying, climbs the tech ladder. It's just not climb. I feel like it's flying up. So, I just feel like it's not just slowly climbing, it's rapidly climbing. Valuation time, ladies and gentlemen, valuation time. So got my notebook, got my pen, let's go. I deployed an auto-regressive integrated moving average, so ARIMA time series forecasting model, because why not, to forecast Oracle's EPS for the next 3 quarters. The ARIMA model, I've mentioned this time and time again, is beneficial for investors for several reasons, such as more user-friendly and interpretable coefficients, automatic removal of mean shifting trends, and the ability of the model to balance both fit and complexity through information criteria, such as the Akaiki information criteria, AIC. Ignore all the technicals. All I'm saying is I just deployed a time series forecasting model called ARIMA to figure out what Oracle's next 3-quarter EPS could be. Data from the last 81 quarters were collected to predict the future EPS, with the first 77 quarters used as a training sample and the last 4 quarters used as a test sample. The out-of-sample testing resulted in a mean absolute error of 0.078, root mean squared error, RMSE, of 0.095. So 0.095 is close to 0.078, which actually suggests that there are no extreme outliers in the model. And it also had a mean absolute percentage error of 5.01%. A MAPE closer to 5% is considered excellent based on industry standards, which makes the model appropriate to forecast Oracle's EPS. So once the model forecasted, what you got was this. In Q2, projected EPS is 1.62, Q3 is 1.45, and Q4 is back to 1.62, which is not very, I know it looks like very trending pattern, but it's very common because if you actually do look Oracle CPS in the subsequent quarters, it tends to be around those levels. Even in Q1 was 1.47. So it seems to be 1.45, 1.6. So it's in that region. So I'm not surprised the model, but hey, the model errors are good and are low, and it did accurately forecast the EPS in the testing phase. Now, when you put all this value together along with 1.47, you get FY26 EPS of $6.16. So FY26 EPS comes in at $6.16. According to Seeking Alpha, Oracle currently trades at a forward price to earnings of 35.5 times. 35.5 times is the forward PE multiple. The forward PEG ratio, price to earnings to growth ratio of Oracle, currently stands at 2.64, significantly above the sector median of 1.82 and the company's own 5-year average of 1.94. Put it in a table, use these 3 three peg ratios as three different scenarios. And then I used a discount factor of 8.12%. 8.12%, which was obtained from alpha spread. The present value of the projected FY27 EPS, projected value of FY27 EPS comes out to be $6.67. Okay? The present value of projected FY27 EPS becomes $6.67 after accounting for all three scenarios under different peg ratios. So you put a multiple of 35.5 on it, 35.5 on it, and into 6.67, and you get a price target of 237, which actually represents a 17% downside from current levels. So no way cheap. The stock is no way cheap. However, I have to say one thing. Investors have to keep in mind that Oracle has very strong momentum. It's not just the fundamentals. You got to look at momentum as well. It as reflected by the A- grade on Seeking Alpha's momentum scale, which is strong. The momentum grade is likely to be further revised further upward, given the whopping 36% jump seen in the stock post the earnings release. And while the stock hit 300 levels and is now playing in the 276 levels, momentum is still strong. So despite the stock being overvalued at current levels, about 15% overvalued at current levels on a valuation basis, given the strong momentum seen in the stock, I am maintaining my hold rating on the name. So hold rating, so I'm not going to say new investors should buy in at these levels. I'm certainly, you can trim your positions, but I wouldn't say exit the position. So Oracle hold rating, 237 price target, which is a 35.5 multiple and a $6.67 projected earnings. Put simply, while the company's growth story may have leveled up, and while I continue to love the name, significant gains made by the stock post the earnings release and then subsequently post the OpenAI announcement and so on offer a perfect opportunity for investors to take some, not all, chips off the table, and which I've done, by the way. I've significantly reduced my position in Oracle and invested elsewhere. Bottom line, despite missing on both the top and bottom lines, it was a brilliant quarter from Oracle, in my opinion. The company's growth is certainly getting fueled by the AI revolution, as evidenced by the whopping 359% year-over-year jump in the company's RPOs, which came in at $455 billion. The company continues to spend, as evidenced by the announcement. The company would be ramping up its capex spend, but no one, in my opinion, can question the spend anymore. OCI continues to deliver, and the approximate $500 billion in RPOs clearly shows that the growth is likely to explode in the coming quarters, which justifies the company's spending. The more than 35% jump in the stock post the earnings release firmly puts it in overvalued territory. But it also means the stock has very strong momentum. When one factors in these opposing forces, along with the future growth trajectory of the firm, the best solution, in my opinion, would be to trim, not exit, one's existing position in the name. I wouldn't be chasing the stock at current levels if I was a new investor looking to buy for the long term, as I believe that there would be more attractive entry points once the euphoria of Q1 earnings lose steam. Now, there have been a lot of questions surrounding Oracle and the AI revolution in recent weeks. While I don't expect the skepticism to die down anytime soon, even the harshest of the skeptics cannot argue with the fact that Oracle delivered in Q1 and is likely to deliver for the foreseeable future. If anything, Q1 showed that Oracle belongs in the major leagues of the AI revolution. That's all the time I have for you this week. If you have a specific Indian or US stock doctor, for the doctors to dissect and diagnose, do tweet me at Uttamvinay, UTHMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. Certainly hope to be back next week to continue the momentum of the show. Until then, stay safe and make some money.